Welcome to Trading Nation. I'm Frank Collin. A veteran market forecaster is intensifying his inflation warning for 2021. Joining us now, Jim Bianco, president of Bianco Research. Jim, welcome. Happy holidays.
Happy holidays to you.
All right. You have a bit of a controversial take here. So tell us why we could see potentially the first inflation comeback in a generation.
Well, let me just emphasize that that's right. We haven't seen inflation in a generation, so a lot of people forgot what it looked like. We've got a lot of stimulus coming down the pike. We've done a lot. We've just passed $900 billion. We're talking about another $2,000 a month, and we're talking in the Biden administration about even more. Then we've got a vaccine coming, and we've got a return to normal. Once you get all of that into the pipeline, you could have a burst of economic activity that could produce higher inflation for the first time in a generation. And if that is indeed the case, that should produce higher interest rates on the back of inflation. Quick word about interest rates. Whether they go up or down is not really important. You know, up isn't always bad. If it is because of real growth, it's okay. But if interest rates are going up because of inflation, historically, risk markets like the equity market don't take well to that. And that's the big worry that I have for 2021.
Jim, excellent point, but isn't there an argument to be made that we've already seen a lot of inflation when it comes to housing, used cars, collectibles, and art, and even the stock market? Haven't we seen some signs of inflation already?
Yes, we have. We've seen a lot of signs of inflation on all of that. But to get into the weeds a little bit, what the pandemic has done is it's changed the basket of things that we buy to a degree we've not seen in the history of the 60-year history that the BLS has been measuring this basket. So we like bicycles, and there's 9% inflation on bicycles, but we're not buying airline tickets. But the way that inflation is measured is airline tickets get a lot greater weighting than bicycles do. So as we return to normal and that basket of things that we buy somewhat reverts back to normal, we buy more men's suits, less sweatpants, then I think you'll see the inflation, the traditional CPI inflation, start to heat up again.
I mean, Jim, you're bumming me out a bit. I'm hoping to still be wearing sweatpants next year, but you're saying I'm probably not. Good to know. So you mentioned real inflation. So let's dig into that. How high could real inflation go next year? And what could potentially offset that rise in real inflation?
Well, that's a good question about how high it can go. The Fed has been looking at having inflation run above its target of 2% on average. And I've been arguing that if you were to get, say, core inflation at around 2.5%, now that doesn't sound like a lot, but that would still be about a 28-year high, 2.5% core inflation, and something that virtually no one has seen. And in this levered bond market, such a rise of inflation would not be taken very good. Now, what's holding it back from showing up now? The economy is still struggling. And with the economy still struggling, and in the month of December, as we've gone into the holidays, the economy has slowed down to a degree that we haven't seen since the March lockdowns. Now, that's to be expected, and it should pick right back up next week. So it's not permanent, but that's holding back the inflation. But once we get past this and the vaccines start really rolling and everybody feels like the light is at the end of the tunnel, then unfortunately, I think we might see the inflation, and the consequence of 21 will be higher interest rates, not on the back of real growth, but also on the back of inflation.
All right. So if we do see that inflation come back, how do you see it impacting the stock market? We know how the pandemic's impacted the stock market, and as you mentioned, changed our consumer buying habits and also kind of led to a greater valuation of tech. But if the inflation comes back, what sectors do you see being impacted the most?
Well, the problem the stock market has going into 21 is by most standard metrics, price to earnings ratio, market cap to GDP, it's overvalued. Now, a lot of people expect it to stay that way for another year. If we don't get inflation, that can actually happen. And you can actually have the market stay at these elevated levels. But if you do get rising interest rates on inflation, and let me rephrase inflation, a loss of purchasing power, you and I and everybody else will have less things to buy with $1 in a year than we do now. And that will crimp earnings. That will make mortgage rates go up. That will make borrowing costs go up. And that historically has not been good for risk assets. That's why this inflation story whether it pans out matters. And quickly, what if I'm wrong and we don't get inflation? Then mailing checks to people, all of this trillions of dollars of stimulus is going to show that MMT works. And I don't think we're going to stop doing it. And there'll be a paradigm shift when it comes to thinking about how monetary and fiscal policy should operate. And that what we've seen over the last month or so with the stimulus packages, that will become the order of the day. Because if there's no consequence to it, it shouldn't stop.
But Jim, before I let you go, haven't we seen the consequence? As you mentioned, there are a lot of items that are out there that are consumer goods, and what for many people is their biggest investment, their house, that's experienced inflation. So haven't we already seen the consequence of sending out those stimulus checks? And won't we still continue to see the consequences if we send out $600 or $2,000 checks?
Well, you're right. We have seen the consequences, and a lot of people think that those consequences have largely been positive because a lot of those stimulus checks have gone in the savings. So they flowed to everything from mutual funds to ETFs to Robinhood accounts to our homes. And that has been largely perceived as a good thing. It actually isn't perceived. It is a good thing to see those asset prices go up. But if we go to the next level in 21 and I stop plowing my money into Tesla stock and I start buying things for my house or purchasing more clothes and bidding up those prices, then you will start to see inflation come back.
Jim, thank you very much. And by the way, I'm still buying sweatpants next year. I heard what you said, but I'm still buying sweatpants. All right.
Yeah,
Jim Bianco, Bianco Research. Thanks so much for joining us, Jim. We really appreciate it. And thank all of you for watching Trading Nation. I'm Frank Holland. We will see you next time.